you make more than $500,000 a year, we can actually reduce your taxes by up to 50%, your income tax. Basically, it's something you can't do after the fact. Once the year's over, you can't do it.
Hey everybody, it's Samantha Parinello from Wealth Unfiltered. Welcome back to the show. Today, we have a really exciting topic for you. We are covering all things taxes. So to welcome to the show, we have the COO and Lead Tax Strategist from defertax.com. I'd like to welcome Chris Shockowitz. Hi.
Thank you. Hi, and thank you for having me.
Absolutely. Thank you for joining us. I know that this is probably one of the favorites that our listeners have. Whenever I have a CPA, whenever I have a tax strategist, when someone who's going to help them keep money in their pocket, people get excited.
Yeah, what we like to say is tax preparation costs you money, tax strategy save you money.
Oh, I love that. Well, jumping right in, I'd like to understand how you got into the business of tax mitigation and also what kind of gap did you see in traditional CPA services?
Yeah, at a high level, I'll take a little bit of time here, but I used to work at Intel Corporation, had a pretty good job, and I was looking at, all the money going out in taxes. And so I started getting into real estate. At one point, I owned 85 doors in San Jose. It was all my money. This was before 2007, and I had a cousin who was telling me, hey, there's going to be a crash, get out of real estate. So I did, and I paid a lot of taxes. So kind of fast forward, I basically was forming some organizations inside the company, and they asked me to move to the Folsom area in California. So I moved away from the Bay Area. I used to live in Santa Clara, right in the middle of Silicon Valley. And nothing brilliant about anything I did, but that house I bought for $600K, I was able to sell for $1.7 million.
Wow.
Yeah, and just it was the market, right? And so I was interviewing realtors, and one of them said, hey, I know this guy who can save you money on taxes. And so we had set up this trust structure where I put $1.2 million into the trust, never paid a penny of tax on it. This was in 2018, and I still haven't paid the tax. And basically the way it's set up, I can control if and when I want to pay the tax. So it's a deferral strategy, but the person that did that with me, he and I were interacting, a couple times a year because he was the manager of the money, right? That was in the trust. And he was kind of complaining about his business not taking off. And I was looking for something to do because by that time, Intel wanted me to basically lay off my entire staff and move all the jobs to India. And I gave them the bird, said I quit. And they said, don't do that. You qualify for our early retirement program. Just hang out for a couple months, help me out, which was really nice of them. Essentially, I left and then I was bored out of my skull and I was looking for something to do. And then when all of this situation happened, he hired me as a consultant to help him build out his business and build out his marketing. And then from there, we just kind of hit it off. So we became business partners and he's kind of taught me everything. And in the meantime, I've actually created a couple of new things. For example, we've taken that trust structure and we have a model with crypto where you can sell your crypto, never lose control of the keys in the process, and convert your crypto to basically fiat without paying any taxes.
Well, if that's not going to resonate with people, I don't know what will, because that's like the new thing,
Exactly.
Okay, so there's a line where you guys talk about CPAs. I think they calculate taxes, but you guys eliminate them. I really want to dive into that.
Yeah, at a high level, it's not the CPA's fault. It's actually the client's fault as well. But essentially what they're doing is you're going through life, the year goes by, and then right around January, you start to say, okay, I need to pull all this stuff together for my CPA. And then they're asking the CPA, how do I save money on taxes? And there's certain things they can do after the fact, but essentially you're reporting on history. You don't have a plan. So there's not much you can do if everything's already happened. So if we can actually get in front of the transactions, get in front of basically this year, for example, I'm working with a lot of people. If you make more than $500,000 a year, we can actually reduce your taxes by up to 50%, your income taxes. Basically, it's something you can't do after the fact. Once the year's over, you can't do it. So in a way, the CPAs are recording and reporting on history, and they're finding the best deductions they can given that versus going into the year with a plan. By planning, you can minimize or you can reduce, defer, completely eliminate taxes.
When you mentioned defer, so for people who don't really understand the concept of deferral, can you kind of dive into that a little bit?
Yeah, it's basically the government giving you a zero interest loan. You're deferring the tax bill. So just like with an IRA, you basically take your before tax money, you put it into an IRA, and then you haven't paid the tax on it. At some point in the future, you take the money out, you pay the tax on it. Now, the one thing I like to say about IRAs is that an IRA is an IOU to the IRS. You're essentially eventually going to have to pay that. And it's going to be whatever the tax rate is at the point in time that you do that. So, for example, you can combine if somebody has fairly large IRAs, maybe $1 million, and let's say they're making 250,000 a year, we can convert 250,000 a year of that IRA into a Roth where you're not paying any taxes on it. You just pay the tax the one time. Then we can combine it with our income minimization strategy. So you're basically getting that Roth conversion really for the price of an investment. And it's an investment that pays a nice return. You're taking tax dollars and you're basically buying an investment that essentially you'll never have to pay the tax on that deferral or that conversion. However, so like we work a lot with people that are, let's say, a doctor, they're a W-2 employee, they're making 1.1 million a year, they have no write-offs, they're paying 400, 500,000 a year in taxes. Well, we can cut that tax bill in half. And then they can now have some money to invest and then start growing things in addition to just paying out their salary every year.
You mentioned physicians, but what types of clients are the best or the ones who can actually utilize the strategies you're talking about?
Yeah, it's pretty broad. So we'd like to say it's basically real estate owners, both homeowners and investors, business owners, and high income earners. So if you think about how most people make wealth in the United States, they're either really good at something and have a very high paying W-2 job. They're an engineer or an architect or a lawyer or a doctor, whatever. And then basically either that or they buy real estate or they own a business. And there's other things that people can do, crypto millionaire, et cetera. But rather than these kind of one-off things, those are the three kind of mainstream ones that we see. And if you're a business owner and you're a serial business owner, you want to, serial entrepreneur, you want to sell and buy the next business. Well, wouldn't it be great if you could sell that business, not have to pay the tax bill and have more money to go into the next business? We can do that. If you're a real estate owner and you want to move basically money from your real estate holdings into buying a business, or if you're a crypto owner, you want to go sell your crypto and go into real estate. So if you want to change asset classes, that's usually the point where you have to pay a very large tax bill. I learned that personally with my apartment buildings, but we have ways basically to where you can make that sale, defer the tax, then reinvest, and then that 30 to 50% you would have given to the state and the Fed, you can actually reinvest. Now, why does the government do that reinvesting? Well, pretty much if Americans invest in America, we the people win. I love that statement. And it's very true because if you look at the tax code, it's actually a steering mechanism. Most people think if you go look up the definition of the IRS tax code, what it says is the statutory rules set by Congress to determine the amount of taxation on your income. But if you look at it, that's what that part of it is about 10% of the tax code. The other 90% of the tax code is telling you how to save money on taxes. Why? Well, let's take some examples. If you get married, two people financially are much more strong than one person. So you get a tax break for getting married. You get a tax break for having kids. Why? Future taxpayers. In addition, you're going to basically build out that family. And in the process, kids are the biggest driver of consumption on the planet, right? Then next, it's owning a business. Well, why do they give you a tax break for owning a business? Because you're providing jobs for other people, and businesses also drive consumption. They drive the economy. You go walking down the street or driving down the street and look around. Someone owns all of those buildings, all of this infrastructure. Why? Well, they actually got tax breaks to basically go do these investments and then basically sell them and go into something bigger. So the government's got actually a steering mechanism to help you invest in the company and grow our economy. And it's one of the combination of essentially capitalism, personal freedom, and personal accountability. Those three things are the foundations of America. The founding fathers basically based all the principles on those three things. And what they've done is then taken that into our economy. We have the strongest economy in the world because we've got this beautiful combination of things that drives wealth. And they don't teach this in school. And in fact, we believe the financial system's broken because fundamentally, who does the average person go to for advice? Let's say I'm selling my home. I basically, like my home, I bought it for 600K. I sold it for 1.7. Who do I talk to? I talk to the realtor. The realtor says, I can't give you tax advice. My broker won't let me. I go talk to an investment advisor. Investment advisor says, oh yeah, go ahead and sell it and I'll help you earn back the money. You go talk to your CPA and the CPA says, here's how much you owe in taxes. Well, where do you go to figure out how to save that money in taxes and go reinvest it? That's essentially what we do.
Incredible. Well, I love that. And I think if more people had that type of education or at least, exposure to someone like you, it would change our economy and it would change what we're doing out there for the better.
Yeah. Well, what we're trying to do, we like to say that at every street corner on a major city, you can find somebody to tell you how much you owe in taxes. Where do you go to not figure out how not to pay the taxes? So our kind of target is, you were asking about target audience. If you've got about 2 million or more in assets, that's basically the spot where we can help people a lot.
Wow. Okay. Good to know. So there are a lot of people probably listening who have filed extensions for this year's taxes, or they're like, okay, it's about the time to pay the piper. So for them, for those people, are there any tax strategies that you could say right now that you're like, I would implement this one, or I would, because I know you talk a lot about more foresight, having the proactive nature, but is there anything that you can do now for those people, or any advice you give them?
Yeah, so it all depends on timing. But because October 15th has passed, it's kind of, too late for 2024. For 2025, basically, if you're looking to reduce income taxes, like I said, and you're making about 500,000 or more, there's things we can do. If you're selling a piece of real estate, for example, or an asset, and then it's been within 6 months and you have a capital gain, we do have some stuff after the fact, for example, qualified opportunity zone. We have actually really good suppliers that we work with that provide those capabilities. And what it does is it allows you to, let's say you sold something this year, you saw this podcast after January 1st, and you go, oh man, what do I do? I now have this $100,000 tax bill. Well, the qualified opportunity zone could go back up to 6 months. So from the point in time you receive the cash, you have 6 months to invest in a qualified opportunity zone. That would actually let you, let's say you had a $400,000 basis and a $100,000 gain. Well, that basis is your money. The gain is essentially what's taxable. We can take that taxable amount, and it doesn't have to go to a QI like a 1031 exchange. And essentially, you can put that into a real estate investment, and that investment can generate a return. It will also defer your tax bill. And then if you hold it for the 10-year holding period, at 10 years and 1 day, it comes out tax free.
Wow, that's really powerful.
Yeah, it's a very powerful tool. I do that a lot with people who are selling some stock to buy something, and then they're going, "Man, I got this stock capital gain." Well, we can take that gain, put it in QOZ, and they can use the basis to go buy whatever, and then they're paying no tax on that sale.
That's incredible. Yeah, one of the assets that Viking has, we just found out that it's in an opportunity zone, a qualified
Oh yeah.
opportunity zone, and that's like the new thing. We're like, wow, this is actually pretty advantageous for many
Yeah.
people. So we better let people know that this is an option now.
Yeah. Yeah. It's definitely a powerful tool. And that's what I do is I kind of look at everything as tools. So if you're selling real estate, for example, and we're getting in front of the transaction, we've actually got 17 options of what you can do with that real estate sale. If you're selling a business, we've got three. If you're selling a primary residence, we've got three. But then after the fact, it really kind of comes down to two things. It's either opportunity zone or go reduce the tax bill.
Are you looking to build sustainable wealth and achieve financial freedom? Viking Capital can help you do just that through multifamily investing. With a team of seasoned real estate experts, Viking Capital conducts deep financial analysis and data-driven asset management to deliver outstanding returns. Their strategy focuses on low-risk opportunities with significant value-add potential, preserving your capital while maximizing long-term growth. Join them and be part of a success story. Viking Capital has acquired 30 properties and manages over 6,000 units, all thanks to their dedicated team and valued investors. Discover their current deal offerings at vikingmultifamily.com and start your journey to financial freedom today.
When you talk about reducing a tax bill, so one thing that I know from working in real estate is that well, first of all, that the tax code just changed and now 100% bonus depreciation was reinstated. And when it was a phasing down, obviously people were trying to take advantage of it as much as they could. But now that it's back up, how powerful is that for the strategies you're implementing?
Very powerful. So, for example, one of the things we do that's pretty unique, let's say you've got a piece of commercial real estate, or, well, yeah, it has to be commercial real estate. You start with a 1031 exchange. What we can do is basically sell that property into a special type of Delaware statutory trust. A Delaware statutory trust is just a securities wrapper around a piece of real estate. The whole idea is somebody else is running that piece of real estate. So if you're tired, we like to say, if you're tired of tenants, toilets, turnover, teenagers, termites, and you don't want to manage that stuff anymore, then you can go into a DST and just get mailbox money. Somebody else manages the property. They pay you a percent. And both TSTs we kind of use as a tool because they're a good investment, but they're not spectacular. You're not going to make 10% IRR on a DST, right? But you could make a pretty decent amount of income and you don't have to do anything for it. But we have one type of DST where when you basically sell the property, the money goes to the exchange accommodator, the QI. We basically do an application, that money moves into that DST. And by the way, the DST, that securities wrapper, it actually was designed in 2002. It's actually a very strong investment from the perspective of a risk management. Because of that securities wrapper, you're a limited partner. You'll get a K1 each year, get your income quarterly, monthly, annually, whatever. But that you are protected because number one, any loan on that property has to be in place before you buy in and it's non-recourse. Number two is if anybody falls down and gets injured, they can't sue you. So you're actually only risking the money you put into the investment, which is nice about it. Now, this special DST, what it does is it allows you to make your investment, but instead of just getting a coupon rate against the DST, instead, 30 days later after that investment, you get 85% of your cash back tax-free, and you can do anything you want with it. So you can sell a investment property and buy a primary residence. You can sell an investment property. Let's say you go into the DST, as you probably know, my relinquished property, I have depreciation against it. That depreciation schedule carries forward into the replacement property. So let's say I had an SFR, single family residence, that had 27 and a half year depreciation schedule. I had it for 10 years. I still have 17 and a half years on the depreciation. I put it into the DST, it carries over to the new property. But now that 85% cash, I can go buy a new property. And because that's fresh cash, I can restart the depreciation on the new property and do bonus for depreciation. So in this scenario, I can free up cash and I can have three depreciations: my relinquished property depreciation, my new depreciation on the property, and bonus depreciation.
But people who don't understand the power of just the bonus depreciation side on top of everything you're talking about, let's do an example so our listeners can understand. So if let's say they make $100,000 investment into a commercial real estate, multifamily, they get to take part and it's like 45% depreciation that they get to enjoy of the bonus depreciation after cost seg. So what does that mean for them?
Yeah, well, based under the current rules, it depends on what a cost segregation study does. It basically looks at a property and it's basically saying you've got the building, you've got the land, you can't depreciate the land. So now we're just looking at the value of the building, but there's certain things within there that are going to wear out faster than the building, right? Because depreciation is all about return on the wear and tear of the asset that you purchased, whether you're buying a tractor or a building, right? Now, let's say the HVAC, they say will last 10 years. And let's say the wall heater lasts 7 years. And let's say the stoves and appliances and stuff like that are 5 years. Well, what you can do is you can actually take that subset, you can break it out as personal property away from the rest of the building. And usually it's about a 25 to 40% ratio. It depends on the type of building. But let's say in that 100,000 example, 25% of it, they were able to carve off in a cost seg. So you're going to, on a SFR, you probably used to pay $500 to $1,000 to do the study. And then that $25,000 that got carved out, you can then use it as bonus depreciation, which you can accelerate to take it all this year. You get a $25,000 tax write-off for buying a $100,000 building. The important thing is to understand the back end of that. So once you do that, now you go to sell the building. If you do nothing, they're going to say, well, you took this personal property, so you're going to have to pay tax on that personal property piece when you sell the building. You can 1031 exchange that, but at some point you got to pay the piper, right? What most people don't understand is those assets have depreciated, right? Their value has gone down over time. So if you sold the building 3 years later, well then, and let's say you had a 5-year depreciation asset, well, you had 3 years of wear and tear on it. So the carpet that's 3 years old isn't worth the carpet that was brand new, right? So basically you can actually then write down the wear and tear on the depreciated item and then pay less tax on it.
And if you were in a group, let's say like a group investment, is that still applicable to you?
Yeah, it's just pro rata for the discount, for the tax deduction, and pro rata for the reduction in the cost.
Incredible. I love that. That's like a very cool, I think, and powerful piece for real estate. You mentioned that there were also some things that people can do for selling businesses and or selling stocks. I'd love to hear more about those as well.
Yeah. So if you're selling a business, let's say you worked 20 years and you started from scratch, there's no basis in the business. And somebody, like I was working with this one guy, he was pest control. And he goes, yeah, some guy just gave me a crazy high offer I couldn't refuse until I exited the business and then started another pest control company in another state because he had a non-compete in that state. Right. I think it was like $40 million and it was 10 million up front and then 10 million a year over until he hit the 40. So first off, we were able to structure the sale so he didn't pay any tax on any of it, not on the original sale or the installments. So basically, it's through a trust structure, which I won't go into all those details. You can see some. We've got some short videos on our website that you
Oh,
can
great.
check out. But basically, then what he did is he used some of that money to go back in and start the new business. And he still didn't pay tax on that money to go start the new business. And then that business basically generated an income, and we were able to offset some of the income by having to go back into the trust, et cetera. Pretty much, if you could tell me what your goal is, I'm going to always want to start with, if there was no tax bill, if there was no limitations, what would you do with the money? And then, well, and what asset is it that you're trying to sell? And what's your goal? What do you want to try to accomplish? And some people don't realize that they have options. And so they think, well, I'm selling this building and buying another one because I kind of have to. Well, actually, what if you didn't have to? What would you want to do? I asked this one guy that, and he goes, I'd be riding my mountain bike any day. And I go, okay, every day. And I said, okay, let's figure out how to do that. And we showed him how to do it. And he's like, I didn't know this exists. And like that one DST one, I was just in a group last week, these senior real estate investor guys, and this guy's going, I've been doing real estate for 30 years. I've never heard of that. How come I never heard of it? And I go, well, you never talked to me.
Good answer.
Yeah.
I love that. You were saying how you created a new strategy that is basically for crypto. So I'd love to hear more about what you can do for people who are either exiting from their stock portfolio or
Oh, yeah.
Bitcoin or whatnot.
Yeah. So from a stock, it really kind of depends on how much stock we're talking about. So like if you're just selling off some stock and you've got about 100,000 or more of capital gains, QOZ works really well. If you're looking at bigger numbers, like north of 5 million in gain, then we can actually use our trust structure. And that trust is incredibly flexible. It basically not only defers the tax bill on the sale, but it also defers the tax on what's in the trust as it grows. So it's kind of like an IRA. And like an IRA, the taxes get paid on the back end when you take the money out. But as long as it's in the trust, it grows tax deferred. And we do have estate planning options that could take all of that outside of your estate, and you can inherit it tax free, et cetera. But that's a lot more complicated conversation. But then on the crypto, we basically use this trust structure. And the whole idea is we treat the crypto as the asset of a business. So we set up an LLC, single member LLC, taxes sole proprietorship. You're the single member, you're the owner. And then essentially our trust buys that LLC, and therefore it buys the assets in the LLC. So it buys the ownership of the crypto. Then we then bring the crypto, the person that we bought the trust from, we bring them on as a manager. So that it's not a paid position, but their only job is to sell the crypto. So basically, the original owner of the crypto never gives up control of the keys. They can decide when they sell it. They DCA out. They've got a 6-month window to do it. And then during that 6 months, we basically just convert the native coin to stable coin. And then basically we turn the stable coin to cash, right? That cash drops into a custodial account like a Schwab or a Fidelity. And then from there, we go invest it based on the investment plan we put together at the beginning. And the whole idea is that as long as that person never personally takes possession or control of the cash, they don't pay the tax bill. So what do? They work with me as an investment advisor, and I manage the money, and we go invest it based on our plan that we put together. Now, some people want to take that money, like I've worked with several people recently this year, where they took that cash out and they basically put it into an LLC that then does hard money lending. You could also take that money out and go buy real estate. I have a lot of people that want to do that. And it's unfortunate where crypto's going right now. It's going down. But I don't know. There's a whole group of people basically saying we think there's going to be a bottom and it'll test the high again. And there's a group of people saying, oh, we've missed the mark this time. We have to wait for the next cycle. We'll have to wait and see what happens.
Yeah,
For,
interesting.
for the 85 people I'm working with that are looking for that next cycle going up, they'll be able to cash out, DCA out, turn it to cash, go do what they want to do with it.
If so, for people who missed it, maybe like if is that 6-month window basically mean that they're gonna just have to take losses?
Well, it depends. So this is getting into some stuff where we would have to have conversations with the lawyers. But if
Okay,
they've
got it.
never sold anything, well, then we could just say, okay, we'll let them buy it back, essentially.
Oh, okay. Yeah. Yeah, that makes sense.
But once you start selling, yeah, you got to cash out.
That makes sense also. Okay, very cool. I've never heard of any of that. That's like very intriguing and very cool. And I know that we have lots of people who've been dabbling and are very unsure about like crypto and all of those pieces. So I think it's really
Oh,
cool to have some tax strategies already in place. I didn't even know that was possible. Yeah, I figured that's a little bit further down the road.
well, yeah, we call it the DeFi Wealth Trust because we basically work with DeFi, decentralized finance.
Wow. Incredible. Incredible. So I want to go back to something I didn't ask you, which I usually start each episode with when it's someone like you. So I want to ask, what's the number one mistake you see in your line of work consistently?
Yeah, people sell the asset and then say, oh, how do I save on taxes? Now there's options. We get in front of the sale, you got a lot more options.
Got it.
But I would say that's the number one thing. Or, they're waiting until April 15th to decide, okay, what are we going to do for my taxes? And then they're mad at their CPA. Well, you didn't give them much to work with if you don't have a plan.
Right. Absolutely. I feel like taxes are such, even though they're a hot topic, they're also something that we all just kind of want to push away as much as we possibly can. So procrastination tends to be the problem.
Yeah. Yeah. And even if you're a W-2 employee, there's things you can do. And if we're saving money on taxes, you could, for example, increase your deductions and then have more money in each paycheck. And you could decide to set some of that aside to then make that investment later to reduce your taxes so that you have more money in your paycheck.
So you guys not only do feature strategy, but do you also help with the deduction and like actual taxes themselves? Or do you not
Yeah.
pile?
Yeah. We're not tax preparers. So our licensing is investment advisors. But what we've done, I mean, my business partner and I, we have these strategies because we've kind of felt the pain and looked for ways to go fix it. And then when he and I kind of ran across each other, he already had the company built, but then we didn't have kind of, I guess I'll call it systematized. So we basically put things like, if you got this certain asset and here's your goal, here's what you do. If you got this amount of income, here's what you can do. If you're above 500K, we can do these things. If you're below 500, but you're above 250, here's things we can do. So we've got models. We also actually have a training program for investment advisors. We actually train them in terms of what we do. We've got about 50 advisors in that program.
That's incredible. So people who are helping just with investing itself, like actually where do you invest? Not necessarily tax related, but you guys are helping them through that.
Yeah, we're helping them add that tax strategy piece to their book of business.
I love that. That we definitely need more of that. This year, I've actually had one other person who does something similar to what you do, but not to the same capacity. And it was the first time I had ever heard of like true tax strategy versus mitigation. So I think that like the terms sometimes get, I think, cross together. And I'm always like, I don't really know. And then once I hear someone like you, I'm like, this makes way more sense. Like the light bulb goes off and I realize how much more proactive that I really have to be.
Yeah. And the whole idea really is from a strategy perspective, there's a lot of companies out there. What we like to say is, okay, so we often work with realtors and we basically help them get listings for people that don't want to list with them because they don't want to pay the tax bill. So what's the problem we're trying to solve? Well, essentially, what do you say to your client as a realtor? They say, I don't want to list because I don't want to pay the tax bill. And you could say, well, go talk to your CPA. Well, do they ever come back? No. Does the CPA have any better answers than they had the last time they talked to their CPA? No. And in fact, what happens when these people go on the internet and search and go look for solutions? They don't even know what question to ask. So oftentimes they'll go out on the internet and they'll see a few things and they'll start talking to people. And what happens is those people believe that you're talking to them because you know what their solution is and you want their solution. So they're going to try to sell you on it. That's not what we do. What we do is we listen to your situation. What's your goal? What's the asset you're trying to sell? What are you trying to accomplish? And then we basically take our experience with the 40 different things that we do, and then we put together the right pieces, and then we create options. And you can choose like which option is right for you. And you can also choose that none of these options are right. No harm, no foul. We provide that as a complimentary service. But the whole idea is we've got the experience to know what are all the options that you actually have available to you. And then from there, you can choose what's the right one versus I'm going to go talk to this guy and they're going to, squeeze me into their solution because that's what they get paid for is selling those one or two solutions. We don't get paid for selling you a solution. Matter of fact, we don't even want to sell. In our first meeting, the first thing we want to do is determine if you even have a tax bill. I don't want to sell you something you don't need, and I don't want to put you in a solution you don't understand or isn't right for you. So our whole business philosophy is education first, then we go into options, then we go into providing the solution if they want the solution to be provided.
So I want to wrap up with a couple of things. The first thing I want to ask is anyone who's listening, I'm sure, is probably like, how do I connect with this guy? I need him. I need him. I need him. So Chris, tell them how they can connect with you.
Yeah, if you go to defertax.com, there's a bar across the top, and based on your situation, if you're a high income earner, a real estate investor, business owner, there's some blogs that you can link to right off of that. And at the top, also, you can hit the drop down and go to our videos or defertax.com/videos. And there's little short 2-minute videos on our most popular strategies. And if you're interested and you want to talk, chris@defertax.com. Chris@defertax.com is my email. And then my appointment link is defertax.com/Chris.
Okay, perfect. And my last question for you is a piece of advice. I would like to know what piece of advice you would give anyone who year over year is trying to have the best tax strategy in place. What's one thing they should be doing?
Talking to a tax strategist. I mean, it sounds self-serving, but that is the idea. Have a plan. Don't exit the year without a plan, because once the year's over, you're too late for 90% of the options.
So when's the best time for them to do this? Is this like quarter through the year, halfway through the year, 3/4? Like when should they be like, okay, I'm talking to my person?
Yeah. Usually it's when you're making a change. So
Okay.
it kind of depends, like with the doctors, okay, talk to us right around June-ish, because we'll basically have our options for that year figured out, and then we have something to talk about for high income earners. For people who are selling assets, it's to have a conversation before the sale of the asset. If you're selling a business, you're in LOI phase, you're looking at letters of intent from offers. That's a good time to talk, all the way up to a month before sale. But if you're going to sell next week, there's just not enough time.
You actually made me think of one quick question. So you're talking about individuals, but what about companies, people who are selling a portfolio and they have a ton of other investors? Would you be able to help a large scale, or is it just individuals?
Yeah, these strategies do scale. And like typically it all depends on what we're doing. Like a business owner, if they're looking at, like I spoke with a guy, 30 businesses. You've seen, yeah, this one's over here, this one's over here, this one does this, does that. Okay, the first thing I would do with that person is say, let's look at all your businesses, look at your goals, and then let's structure those businesses, get the right entities for the right business and the right flow. And then we look at how the money comes together to you, how we go most tax efficiently structure, because just the structure of your business can make a huge difference in taxes. Then we basically apply the usual things, like you can reduce your taxable income for your business through retirement plans, through self-insurance, through other various means. And then now you've got this amount coming to you. Well, then now we can look at how do we structure reducing that depending on what type of income it is. If it's active income, there's certain strategies. Passive income, different strategies. Capital gains income, different strategies. So we just go walk through it and apply it and then put together the plan. That would be somebody that's more sophisticated and has a bigger problem. And maybe there's a group of investors that own that group of companies, right? Down to the individual who's just saying, hey, I'm selling my home, my primary residence. I bought it for $1 million in San Diego. Now it's worth $5 million. I don't know what to do. Well, we can help you with that.
Incredible.
But have a plan before you sell.
Well, I can't thank you enough. I know the listeners are probably thrilled to have this episode, but thank you to all of our listeners for keeping us active and listening to an incredible episode with Chris. And thank you, Chris, for joining me today. I appreciate it.
Well, thank you very much. I appreciate it. Good questions today.
Thank you. Thank you for tuning into this episode. We truly appreciate your support. Don't forget to subscribe, leave us a review, and share the podcast with your friends. Until next time.